Thank you. I'm going to show how distributed ledgers and smart contracts that run upon them can transform the insurance and industry by bringing transparency, creating an environment that enables trust, and making the barriers to entry low. First, a reminder about distributed ledgers. In distributed ledgers, multiple participants are allowed to update the ledger and under specific rules, and everybody else verifies that the rules were followed. And the magic of these rules is that the ledger which we get is still consistent. It is still the same ledger on different nodes, and even in the presence of malicious actors. Distributed ledgers can run on different technologies. One already well-known one is blockchain, where individual records of the ledger are grouped into blocks, and blocks are chained one after another. A more recent technology is based on directed acyclic graph, where individual records are connected directly to each other rather than being grouped in blocks. And this makes the system a lot simpler. Byteball, a distributed ledger which I designed, is based on DEG. But whatever the technology, the promise of complete transparency and automatic verification by multiple independent peers brings us what we get from distributed ledgers out of this is trust. And the trust, this changes everything. Now, two parties who don't know each other, they can make a contract on the distributed ledger. They can encode it in a machine-readable form and write it onto the ledger so that everybody else can see and verify the contract and do it in automated manner, thus enforcing that the contract executes exactly as agreed upon. This is called a smart contract. One additional thing which is special, which is unique to Byteball, is that the contracts are not only recorded on the distributed ledger and can be verified by everybody else, they are also human readable. Users can read them and see what they're offered to sign, what they're paying for, what is going to happen to their money under various conditions. That means that the smart contracts are not only machine readable, they're also human readable. And users also can compose contracts and offer them to other users. And they don't need to be developers. They don't need any special tools other than the standard wallet. This smart contract can be an insurance contract. And for example, we want to make a flight delay insurance. Both the insurer and the insured pay their respective share of the total to the contract. For example, the insurer pays 90% of the total. The insured pays 10%. These 10% are the insurance premium. And the contract says that the money locked on the contract can be unlocked if the flight is delayed by more than 1 hour, for example, and the contract can be unlocked by the insurer if the delay is less than 1 hour. The contract also specifies a trusted third party, an oracle, which is supposed to provide true and accurate data about the actual delay of the flight, of this flight. This is an example of parametric insurance, where the insured event is a publicly known, easily verifiable event, and the payout amount is bound to is known to in advance rather than being determined based on damages. We could make other contracts, similar contracts that insure against other negative events. For example, extreme weather events such as less than X precipitation within the last few days, less than X snow on specific days, less than X sunny days within a date interval, wind speed above some value, such as a hurricane, more than X precipitation within 1 day, or other unfavorable events, such as court ruling unfavorable for the uninsured, issues of legislation that is unfavorable for the insured, for example, tax raise, an unfavorable party wins elections, the Fed raises interest rates, or OPEC decides to cut oil output. The nice thing about all these contracts is that they are trusted to execute exactly as agreed upon. There's no way that the other party doesn't pay or doesn't deliver, because everything, the contract and the execution, is verified by multiple independent peers automatically. And this means that in order to this means that the other party doesn't need to be a big insurance company, a big trusted insurance company. It doesn't need to have any established reputation. It can be even an individual, even an anonymous individual. And this means that the contracts can be made peer-to-peer. This means that the barriers to entry in this market are low for everyone who offers his insurance products on the distributed platform. And this means this allows more agile, competitive participants, players to enter this market and make it more competitive and make better conditions for the end users, for the consumers. The end result is that we get on the distributed ledgers, everyone can become an insurer and offer his insurance products on a platform that is transparent, enables trust, and is accessible to everyone. Thank you.
Thank you, Mr. Churyumoff. Are there any questions on smart contracts and the presentation? Yes. Let me take the microphone and come up to you. Here you go.
Hello. Thanks for explaining the parametric insurance use cases. I'd be interested to know how Byteball is different from other DAG-based technologies, and yeah, how does it help? I think Etherisk also does something similar, right? Or maybe other players in the insurance industry. So how are you differentiating, building your use cases for this?
So how Byteball is different? Well, the main difference is that in Byteball, the smart contracts are really easy to read by end users. So end users can see what they are signing, what they are paying for. They don't need to be developers. They don't need to trust developers. So they just read the contract like a regular contract. This adds trust to the platform because the users, it's quite transparent. They see what is going to happen.
Okay. Oh, you want to follow up? Yeah? I saw also another hand. We have time for 2 more questions, and then we have to... Just a short follow-up.
How is this different from Etherisk, from what Etherisk does?
Sorry?
So there is this TUC-based startup called Etherisk, and they do exactly this, parametric insurance use cases for flight delays, for example. And I'm interested in knowing how this is different from what they do.
Well, in Ethereum, the smart contract is code, is computer code. Well, it works, but for end users, they can't read the code, and it's...
She will come to you after the presentation. She was talking about Etherisk.
Etherisk is, yes, I'm saying about it. It is called on Ethereum, it's based on Ethereum,
yep.
And it's different in a way that it is the smart contract, like all smart contracts in Ethereum are computer code. So only developers can see and trust that they are doing what they are promised to do.
Yep. Final question, short one.
Thank you very much for the presentation. I have 2 questions. One
no,
is...
you have to choose one.
Okay, I make it very, very short then. You say that you integrate certain information from the internet, I guess through APIs. How do you push them into your blockchain, and how do you make sure it's decentralized information and not centralized? Because then it doesn't make sense to say it's centralized, right?
I didn't hear, sorry.
Okay, you get your information about the truth. What is the truth? Let's say a flight is delayed or not delayed. You need to get it from somewhere.
Yes.
From the internet. How do you make sure it's a decentralized information? Because if it's a centralized information, why do you store it decentralized? That doesn't make sense. You know what I mean?
Well, we have a contract between the 2 parties, and the 2 parties decide that they trust some oracle, a data provider, who is supposed to provide true and accurate data about the event. And if they don't, if the oracle lies, it can lie only once, because the data that they provide is easy to verify.
Okay, give it up for Mr. Churyumoff, ladies and gentlemen, of Byteball.
Thank you.